My name is Joseph Andiwo. I'm the head of the Secretariat, at the same time a wealth management advisor. First is to welcome you all to this program, whereby we are going to walk you through the manifest, that is basically savings and investment. But before I dig deep into the presentation, allow me to introduce my colleagues.
Thank you so much, Joseph. My name is James Kairu, a member of the Arima Fund Secretariat. Welcome all.
So Kelvin will be able to walk us through, as he's going to introduce himself later on, he will walk us through areas of micro and macroeconomic outlook as far as savings and investments are concerned in the Kenyan economy. But before then, allow me to introduce also our panelists. We have Joseph Njuguna, who is also joining us. We'll be able to take some of the questions at the tail end of this presentation. First, let me walk you through the introductory part of this presentation. That is, who are we? Arima Fund Limited is basically an investment firm that was established sometimes in 2014. The sole purpose was basically to enable members who invest under it achieve what we call financial stability, security, as well as independence. And how do we get to achieve that? We basically get to achieve that by giving our members the opportunity to invest in the available investment opportunities that we have within, as well as also giving them the best advisory services on the general market outlook as far as investment is concerned. We are located in Upper Hill, that is Upper Hill, Nairobi, 26th floor, that is the Old Mutual Tower. So once you walk into our offices, then you will be able to find that information that probably you need as far as getting to understand the investment world. We are diverse in that we give much information as far as private offers are concerned. At the same time, we also give information as far as someone who intends to invest in the public market. By so saying public market, I mean investment in shares, at the same time, investment in government securities, including T-bills, as well as the treasury bonds. We also go beyond that to also engage individuals in the diaspora, so as to be able to really tap on that area and give them the opportunity to also invest their money back at home. So that is just a brief preview about who we are as Arima Fund Limited. So we have so many years of business existence from 2014 to date. That is almost 10 years, but before that, we were existing as Investor Network. We just came to change the name sometimes in 2014. We also partnered with AXAV, that is a leading actuarial consultancy in Africa, which is also having over 2 decades of business visibility in Africa, and to be specific, 13 African states, and also managing over 350 billion worth of assets under advisory. I already spoke about our vision, and the mission for Arima Fund Limited is basically to enrich and positively impact lives by providing that much needed access to unique and rewarding investment opportunities. So at the tail end of this presentation, you will be able to really get to understand what basically we do and what we basically have as far as wealth management is concerned on the area of savings and investment. Our team basically comprise of well-experienced and qualified individuals who basically offer sound advice on how to invest. Then upon investing, how do you diversify the risks and also to maintain that profitable asset portfolio. We have levels of governance. We have us who presenting this, offering this program of today, dubbed Manifest. We basically we are called the governance, sorry, we are called the secretariat, who handle basically day-to-day operations of the Arima Fund Limited. Then other than that, we also have the governance committee, who sit regularly to really check on the performance of the fund in various areas that it invests in. Then finally, we also have the board of directors for the Arima Fund Limited. So those are basically the governance structure for the Arima Fund Limited. The objectives of Arima Fund Limited, which has the honor today to bring to you this important manifest training. One important objective that we have as a company is basically to preserve that little or much contributed amounts by members who invest under us. Upon preserving what is contributed, we also ensure that the returns are maximized and always at reasonable amounts of risk. Then the third one is basically that we also generate returns that meet or basically that go above the inflation levels. We all understand the current inflation level in Kenya is high, around 9.1, 9.2. So basically we give our members opportunity to invest in areas that will generate returns that are basically above the inflation rate. Then finally, we also maintain adequate liquidity within our investments at all times for our members. So my dear viewers, allow me to welcome James to walk us through the wealth philosophy and framework, so at least we may be able to understand ways of creating, ways of preserving, and accumulating wealth, because actually that is the point where we have to begin at before we even think of savings and investment. So welcome, James, and take us through the wealth philosophy and framework. To our dear viewers and audience, in case you have any question, feel free to drop your questions on the chat box, and we'll be able to tackle each and every question at the tail end of this presentation. Thank you so much, and allow me to welcome my colleague, that is James Cairo. Welcome, James.
Thank you so much, Joseph, for that small introduction of who we are. I will be taking you through wealth philosophy and framework. And to start with, we are going to have a brief understanding of what wealth is. So basically, wealth represents the overall value of assets that you have. They could be tangible, intangible, financial, individual, or non-individual, and which contribute to your general well-being as a person, as a society, or as an economy. On to the next slide, we have various types of wealth. That is, we have financial wealth, that is wealth that you possess in monetary terms. And we have social wealth, that is your ability to connect with other people, connect with your family members, your fellow employees, friends, and even pets. Then we have mental wealth, which represents your ability to wrestle with tangible and intangible questions of life. And we have also time wealth. So here we are going to define time wealth as a factor of production. You know, they say time, how you save your, basically time is money. So time is also a form of wealth. And then we have finally physical wealth, that is your health, fitness, and vitality. And then to wealth philosophy, we have various ways through which you can make money as an entrepreneur, as an employee, when you're self-employed, or through passive sources of income, for example, inheritance. Then on to the next slide. We have the wealth framework. So the diagram on your right represents how you should manage your money, how you make, how you grow, how you spend, and share your money. So for the making and growing your money, when you're making and growing your money, you're basically creating value to your money. And then when you're spending and sharing your money, you are giving purpose to your money. And as you make, grow, spend, and share your money, what we encourage is you should preserve and protect your wealth through investments. Then on to the next slide, we have wealth management. So for wealth management, we are creating financial and investment solutions for individuals and families based on your needs. And how do we build on your wealth? The following presents the process of wealth management. That is, to start with, you must have a financial plan. We know that from management, everything starts with having a plan. And after you make a financial plan, you should have a budget which you should make and stick to it. The spendings, how you make your incomes, how you spend your money, and all that. Then for the next step is building up on your emergency fund. Here is to cover for the risk that come with unforeseen events, for example, sickness. Then you should always seek to automate your financial life. That is, when you get your incomes, let those bills that you pay, for example, rent, mortgage, your insurance, let them be cut directly before they come into your personal account. And by doing that, you're avoiding maybe delays, penalties that will come along with you having your money into your personal accounts. After automating your financial life, you should manage your debts. And by managing your debts, we mean the debts that you have, you should purpose to pay them on time to avoid interest payment penalties. And when you do that, you eliminate any risk associated with having your debt or failing to pay your debt or your debt accumulating so much. The next step is how you secure your golden years. And by this, we mean by saving towards your retirement, having your pension. Then you should stay diversified. As you invest, you should invest not in one sector, you should invest in various sectors. As you invest in stocks, you invest also in agriculture, other sectors, you invest also in real estate. And then finally, you should purpose to increase your incomes, up your earnings each and every time. There is no time that your expenses or your expenditure will go up to zero, but you cannot minimize them every time. But by having various sources of incomes, not just one, you will be in a better place. Then on to the next slide. Why is wealth management important? It helps you have financial stability, achieve your ideal lifestyle, not ideally the soft life that you desire, plan for your retirement, and start investing in a smart way. Then the next thing is we have various money personalities. These are basically traits associated with our money, that is spending, saving, and investments. And as we go through these money personalities, I want you to ask yourself, where do you lie? You can have one or more traits. That is, if you spend your money a lot, often to impress people, then you are a big spender. If you watch your income closely before you take risk, then you are money sensible. And then for those who purpose to learn in regard to managing your money, that means you are you have a smart money personality. And then finally, the opposite of being a big spender, it means that you are a saver. Then to the next slide. Oh, we have also investors. You can be an investor. You are trying to work on your money so that it brings more and more money. You are a debtor. Basically, you go on taking out loans or debts. And then lastly, shoppers. You purchase now each and every time. You need to understand your money personality, because by understanding your money personality, you're able to achieve your financial goals, achieve financial freedom, and manage your money well. And there is this Swedish proverb which says, "He who buys what he does not need steals from himself." So you need to know your money personality so that you can manage your money well, achieve your goals, and achieve financial freedom. Then we have, to the next slide, we have mapping your finances. And I want us to focus on the table that is on the right hand side. So basically the items and the percentage are what are universally acceptable when it comes to spending your money. And as we go through this, we are going to use the 50, 30, 20 budgeting rule. That means 50% of your income or incomes goes to your needs, 30% of your incomes goes to your wants, and then the remaining 20% goes to your savings and investments. And because food, clothing, rent, and education, but we can have education as a need and wants. But first of all, because we are dealing with needs, we are going to define education as a need. That is basic education, uh, most probably education for your kids. So if we were to add the food percentage, that is 15. The clothing is also a basic need. The 5%, the basic education for your kids, that will take 20% of your incomes. And then rent or your mortgage, that basically adds up to 50%. And when we observe that, guys, we have achieved the 50% rule that goes to your needs. Then we go to your wants. Your wants will include your utilities, the gas, the water, the electricity, the fare, the transport fare, your personal expenses, and entertainment. And we can also include your emergency fund on the part of the wants. And when we add that, we get 30%. Then the remaining part is the savings and investments. After you have allocated the 50% of your incomes to your needs and the 30% to your wants, the 20% of your income to savings and investments will bring itself automatically. So there are no struggles. And I encourage all of you to observe this when you're spending your money. Then to the next slide, And here are the warning signs, that is, which means when you're mapping your finances, you have gone somewhere, you have gone wrong somewhere, maybe you have accumulated debts. So we have the following warning signs. The first one is when you borrow a second loan to repay an existing one, when you issue post-dated checks, when you borrow from Shylocks or money lending apps, when you depend on credit cards or salary advances to provide for your upkeep, and also be aware of social media. Don't purchase or spend your money to impress anyone. Remember, on the part of wealth management, the first step that we started with was financial planning. So we are going to talk about what financial planning is. And financial planning basically represents the process of assessing the current financial situation of an individual. You identify their financial future goals and come up with how you're going to help them or guide them to achieve those goals. Then to the next slide, we have the processes that are involved, or what you should check on when setting your or creating your financial plan. The first one is setting financial goals. Of course, they should be achievable. Then you should track your cash flows. That means your incomes and your outflows, the expenses, how you spend your money, and also prepare for for emergencies. You should have at least some money from your income set aside, and it should be liquid. That means cash. Have at least some cash at home to cater for emergencies. For example, sickness and also other things. Then the other step is purpose to pay off your debts in time. Eliminate them from your expenses as soon as you can. The other thing is assessing and managing your risk. Come up with a plan of the risk that you can face. If you can spread them by diversifying your portfolio, the better. Those risks that you can avoid them. Those risks that you can reduce them. And those risks that you can transfer to a third party, for example, insurance, please take that insurance cover. And then the final step, as Arima Fund, we are telling you to invest each and every time. Then on to the next slide, we have why is financial planning important? First, it helps you identify and prioritize on your financial goals. Then it helps you identify and deal with financial stresses in your life, in your financial life. Then it helps you in financial management, and financial planning also gives you the ability to monitor the progress of your goals. It could be that house that you're planning to buy, that car that you purpose to have in the next 3 years. It helps you gauge yourself where you are in terms of achieving that goals. And then finally, it gives you a financial understanding. You get to understand your finances better, how you spend your money, how you make decisions relating to money. Then I'm also going to talk about debt. And you might be asking yourself why we are talking about debt. If you don't manage your debt well, you will not be able to save your money or even invest, because most of your incomes will go off to paying your debts, and then you will have nothing left to save or even invest. So debt represents something that you owe another party in monetary terms. And there is this guy, Will Rogers, who says, too many people spend money they earn to buy things they don't need to impress people they don't like. So avoid being those people. Then on to the next slide, we have the 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 process or the things that you should check to manage your debts and financial debts. Write your debts down if possible. That is, then identify your debts, which ones are supposed to be paid sooner, which ones have the highest interest, pay them first. Then set a budget. You can use the 50-30-20 budgeting rule. Then purpose to cut on your expenses. The things that you don't need, cut them off, and start paying your debts as early as possible. Seek help for mental health. That is, if you're stressed about your finances, and as Arima will guide you on that. Pay your bills immediately if possible. That is, automate your financial life. Tackle debts with high interests. Tackle biggest debt first, and then sell assets for cash to pay off some of your debts. Then also on to the next slide, we have tips for managing your debts. The first one is you should always pay on time. Monitor your credits regularly. Pay more than minimum if you can. And if you can, pay the whole amount. Know your limits. Know your credit score. Keep it so it should be good. And the other thing is know your debt to income ratio. That is the DTI ratio, which represents the debts that you have each month over the income or incomes that you make every month. And financial experts, they want that your DTI ratio should not be more than 40%. So if you are beyond 40%, you are in a bad place financially. So purpose to pay your debts. And then the last one is build on your emergency fund. That is, have a savings account or cash at home so that you can cater for unforeseen events. And then from that point, I'm going to invite Kelvin to take you through the macroeconomic outlook. Thank you so much.
Thank you, James, for that wonderful presentation. My name is Kelvin Chalo, a member of the Secretariat and financial advisor. I'm going to take it over from macroeconomic outlook. Basically, on that point, we are going to focus on the economic changes, whereby we have the economic output, inflation. We also check on the interest, foreign exchange rates, and the balance of payments. On to the next slide. We are going to check the relationship between inflation and the interest rates. Basically, we are going to focus on the supply and demand principles. For the interest rates, we are going to focus on the central bank. We are going to focus on the central bank interest rates, whereby we are going to look on its rate as per June. It is at 10.50%. For the interbank rate, it is at 8.62%, which is posing the following effects. We have effects of spending, whereby you are not able to spend a lot. We have low borrowing. As the interests are high, the borrowing capability goes down for individuals and other organizations. The other thing, it is a disadvantage to the investors, whereby they will get a low profit. And the other one is it's a merit to the banks. They will be able to get more as they will take the merit of the high interest from the central bank. On to the next slide. We are going to check on inflation rates, whereby we are going to compare different months of the year. As shown by the graph, as of June, it was 7.88%. May was 8.03, whereby there was a drop, which was just a benefit to us. On the other side, we are going to check on the causes of inflation, whereby it is caused by rising wages and increase in money supply in the country. We are going to check on the gross domestic product, whereby in Kenya it is projected to grow by 5.8% in 2023, which is a slower pace than the previous forecast of 6.1% because of the lower growth in the agricultural sector. We are going to see how savings and investments contribute to our gross domestic product. For the savings, they contribute about 16.41% of the Kenyan GDP, while the average value for the Kenya during that period was 20.45%, with a minimum of 13.06% in 1964, a maximum of 29.79% in 1978. For the latest value stands at 20.3%. We are going to check on the fixed income, whereby we are going to check on the T-bills treasury yield. We are going to start with the 3-month treasury bill, which its rate stands at 4.95% compared to 4.87% of the previous market, and 0.75 for the last year, which is higher than the long-term average of 4.17%. We are going to check on the second bill. We have a 6-month treasury bill rate, which stands at 4.79% compared to 4.78 of the previous market day, and 1.22% for last year, which is still higher than the long-term average of 4.48%. We are going to check on the last bill. We have a 1-year treasury bill, which stands at 4.77% compared to 4.66% the previous market day, and 1.84% for last year, which is still higher than the long-term average of 2.88%. On to the next slide. We are going now to check on equities outlook. For the equities, they faced a challenge in 2022, which was a downward trajectory of inflation and a continued economic stability, point to a slightly more positive outlook in the coming months. The other thing, how can we invest in equities? Equities are increase in value. That's basically on the principal amount invested in form of capital gains and dividends. Those are the benefits. We move to save and invest. We are going to first of all understand what is saving and what is investing. For saving, it is described as the process of setting aside some small amount of income let's say your current income, you just set aside some little amount for future use, which will help you just to take care of yourself for that period of time. We have investing. This is basically the process of buying assets that increase in value over time and provide returns in form of income payments or capital gains. We are going to look on their characteristics, saving and investing. We are going to start with the saving part. First of all, saving reduces stress. Whenever you are saving on a later date, you won't have that stress, that financial stress. Saving offers long-term financial security. It helps someone to plan for their short-term goals. It is a step towards achieving financial freedom. For investing, it has some 4 major characteristics. First of all, investing will help you beat inflation. Like for example, investing in Arima, whereby you'll get some returns which are above the inflation rate. That will basically help you beat the inflation rate in Kenya right now. Investing helps you save on taxes. It helps you build your wealth, as we have seen in the previous presentation as given by James. It helps you to achieve and meet your financial goals. On to the next slide. How can we achieve savings and investments? We are going to start on how we can achieve savings. For the savings, you first of all have to record and track your expenses. It will help you understand how you spend your money whenever you get your income. You must also include a saving in your budget. You should find ways to cut spending. You just avoid non-essentials such as entertainment. You set saving goals. Of course, you must save with a goal to achieve something. You will have to pick the right tools and determine your financial priorities first. On to the next slide. We are going to check on investments. Investments, to achieve them, you have to draw a personal financial roadmap. This one will help you to look at your financial situation and figure out your goals and the risk tolerance the risk you can take. The other one, you can first of all and again know your goals, why you are investing, and for the period you are going to invest. The other reason, you should know your risk tolerance and diversify your investments. There's a quote by Benjamin Graham. He says, the best way to measure your investing success is not by whether you are beating the market, by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. On to the next slide. We are going to see the reasons for saving and investing. For savings, it will help you achieve a financial independence, help you be in a position when emergencies occur. They offer financial cushion, and they cushion you against sudden job updates. For investing, it will help you grow your money. We are going to see what are the saving and investment goals. What are some of the goals why you are investing or why you are planning to invest? Maybe you are getting married for medical expenses, your retirement, and your child education. We are going to check on the investment goals. These ones provide a structure and purpose to the money we allocate to investment products, such as stocks, whereby the goals are safety, income, capital gains, building emergency funds, and retirement planning. On to the next slide. We are going to see how to set investment goals. How can we set them? But before, we are going to see something said by Warren Buffett. He said, "Do not save what is left after spending, but spend what is left after saving." That's quite a wise saying, which can guide us. We are going to see now how to set the investment goals. First of all, you have to identify the goals. That's having a reason for why you are investing. You identify the risk, how much you are willing to take or incur. You have the timeline. You should be able to understand for how long you are going to invest your money. The other thing, you should have a strategy. This strategy will help you be able to understand the amounts of risk involved in certain venture. Maybe if it's on the real estate side, or else the cryptocurrencies, you should be able to understand the risks. The other thing is to mix it up, whereby we call it a diversification. We just invest in different parts. On to the next slide. We are going to check on asset classes to save and invest in. On that, we have the equities, of fixed income securities, of the real estate, commodities, cash equivalents, and currencies. We are going to check on the risks and returns associated with the asset classes. Maybe the risk can be either low, moderate, and higher risk, and depending on which class you are choosing. You can take us to the next slide. The diagram below, it shows the expected risks and the returns for various asset classes, whereby they are well shown, and by that you are able to gauge which asset class is high risky and which one is low risky. We are going to the next slide. We are going to understand what is the intelligent approach to long-live investing. This is investing is a long game. Whether you want to invest for retirement or grow your savings, you put your money to work in markets, and it is the best to set and forget about it. We are going to check on the following approaches for long-live investing. We are going to see the reactive and the proactive investing. For the reactive, it's an investment strategy where the investor's decision can change in a short period of time. They can change within a short period of time and change again and again. While proactive is where the investor is focused on reducing the likelihood of problem behavior and allows him or her to be as independent and successful as possible. We have the strategies. We are going to start with the first strategy, whereby an investor can invest in top performing asset classes from the previous year. We are going to check on the second strategy, which is exactly the opposite of the first strategy, whereby you invest on the low performing class, hoping that it will perform better. On to the next slide. We are going to see on the third strategy. This is a strategy where we deal with the asset allocation approach, whereby you can weight the weight of the assets, and you rebalance them each year to the original weight, consisting maybe you can consist them of the 25% of foreign shares, 10% of foreign property, 25% of Kenyan shares, 10% of Kenyan property, and 30% of Kenyan bonds, which is a proactive strategy. We are going to see how can one balance their fear and the greed to get a return. First of all, you should pick investment that you believe in and for the long term, and stick with the companies that have long track record, and the one you are comfortable with. The other way to balance that fear is do not watch day-to-day swings. The other one, don't make decisions based solely on emotions, because emotions are so sometimes they are disgusting and they can make you make some very bad choices. A point to note: fear and greed will always influence the way investors react to the market volatility. So it is therefore advisable not to involve your emotions when making your decisions. On to the next slide. We are going to see types of investments available. Briefly, we can just highlight them. We have stocks, which offer long-term returns and dividend income, and a hedge for inflation. We have real estate. We have money market funds. They offer higher yields and returns. We have government securities, whereby we have the bonds, which are virtually a risk-free investment, as they are governed by the full faith and credit of the government. We have the mutual funds. They are just an easy way to diversify our portfolios, as they are convenient and you can invest your dividends and are low costs and risk. We have the ETFs, the exchange traded funds. They give you an efficient way to diversify your portfolio as well. From that point, I'm going to welcome my colleague Joseph to take it over from there. Thank you.
Thank you so much, Kelvin, for that wonderful presentation. To our dear audience and viewers, in case you have any question, feel free to drop your questions, because we are coming to the end of this presentation in just a few minutes. Feel free to drop your questions, and we'll be able to tackle them. So far, we have around 4, but before then, just allow me to really walk you briefly on some of the goals. Basically, how can someone grow his or her wealth when investing in Arima Fund? You have been walked through quite a number of investment opportunities available in Kenya and even out of Kenya, including but not limited to the ETFs. So basically, how can you grow your wealth? Yes, you have heard about savings and investment. You have heard about the wealth framework, the wealth philosophy, how you can create and how you can preserve your wealth. So the question therefore comes, how can you grow your wealth when you invest in Arima Fund? So Arima Fund basically offers several secure investment opportunities, basically high yielding investment opportunities that you may not be able to find anywhere else. So we have well-tailored investment opportunities or products that gives our members the opportunity to invest their funds, to invest what they have saved, so as to be able to earn good returns and probably to beat the inflation as it was spoken by Kelvin and James. So one thing to note in growing your portfolio, in growing your investment in Arima Fund, is that you will be able, as a member, to earn returns quite higher depending on the products that you invest in. That is one thing. Security is also guaranteed once you invest in Arima Fund Limited, and all that is determined by where we do investing, which I'm going to also mention shortly before we come to the end of this program. So in conclusion, savings and investments are both important components in having a healthy financial plan. That is something that is very, very key. So savings basically provides a safety way to achieve the short and the long-term goals. But even before I walk into the long-term goals, which are basically taken care of by what you basically invest, it is always important to consider where you are investing in, because different investment vehicles, opportunities have got different risk. And you also need to understand your risk appetite. Are you a low risk taker? Are you a high risk taker? All that will determine where basically you are going to put your money into. And as the saying goes, not always advisable to put all your eggs in one basket. It is always good to diversify your investment into different portfolios. We have a portfolio probably in Arima Fund Limited, investment opportunities, another portfolio also probably in the stock market. Depending on what you have in terms of your disposable income, you must have a portfolio also in the government securities like the T-bills and T-bonds. You can even decide to also go the offshore way and invest in the stocks, in the securities, in the commodities available outside our boundaries. In so doing, you will be able to really get value for what you have invested in. At the same time, you will also be able to diversify your risk into various investment portfolios. And the overall picture is basically to allow you to grow your wealth such that even if you probably say that tomorrow, God forbid, you lose your life as that patriarch in your family, then you'll be able to also transition what you are having to your generations. And therefore, that's actually what brings us to the point that was said in terms of financial management and wealth, financial and wealth management. So all these factors are very key when we are looking into ways in which an individual can invest, ways in which an individual can also save, and also overall grow what they have earned in terms of wealth. What questions do we have today? I have some questions dropped privately. One is, where do you invest your money in? Where do you invest your money in? That question, Kelvin, maybe you can take it. up. Where do you guys invest your money in? Kelvin, proceed.
Thank you. Thank you, Joseph. I hope I'm audible. For Arima Fund, first of all, we invest in ACTSAV-related entities. Those are the ACTSAV projects. We have the bank deposits. We have government securities. We have the T-bills, the T-bonds. We also have the well-performing stocks. That's in and out of Kenya. That's where we basically invest the funds collected from our investors. Thank you.
Or maybe you can also as well combine that question. This is another question, that is the investment opportunities that you have in Arima. What are some of the investment opportunities you have in Arima Fund?
Thank you for that question. Arima Fund offers mainly two opportunities. The first one, we have the 15% fixed return, whereby the return is fixed. And the other opportunity, we have the Mana Fund, whereby we invest in agricultural sector, that's basically on the dairy farming, whereby we still offer returns. That's 7 to 20%, which is variable depending on the performance of the sector. Thank you.
All right, thank you so much. Allow me to introduce Joseph Njuguna. Maybe you can as well handle this question. We have two more questions to go. Joseph Njuguna, this probably goes to you. But before Joseph Njuguna, because he will also be able to give a closing remarks, allow me to answer this question. Someone is asking, where do you invest? That is answered. How can I invest with you? Basically, the procedure for you to invest with us, very, very simple, no cost attached. So far, we have seen Kelvin spoke about the two investment opportunities, that is in the fixed return fund and also the Mana Fund that purely invest in dairy farming and returns being varied up to, depending on the performance of the sector, even up to 20%. And also another product we invest in is basically the fixed return fund that invests 80% of funds collected in ACTSAV and its related entities, and the 20% split to fixed, split also to the stock market, the T-bills, and also the well-performing stocks either in Kenya and outside Kenya. So the opportunities we are having is basically in the fixed return fund as well as the Mana Fund investment opportunities. And our returns, basically the fixed return is 15%, as someone has asked. Allow me to answer that. It is 15% per annum return on fixed return fund. Then the Mana Fund basically gives you an opportunity to earn a return between 7% on the minimum and 20% on the maximum, depending on the performance of that sector. And as you can notice, you realize that we offer, therefore, returns that are basically above the inflation, which is very, very key factor when that you need to consider when you are doing when you are making your investment decisions. So to invest with us, just to answer that question, to invest with us, you simply need to visit our website. That is www.arima.co.ke, as you can see on the screen. Those are our contact details. We have the telephone numbers displayed on the screen. We also have the website. And to reach us via email, we also have the info@arima.co.ke. To learn more about what we are doing, the articles we read, we basically release on a weekly basis. Feel free also to visit our Facebook pages, the Twitter handle, among other social media platforms. Lastly, before I introduce or bring in Joseph Njuguna for that closing remark and to also take the question on risk, which I think you can also combine this. Talk briefly about risk versus Arima products. Talk briefly about risks versus Arima products. So Njuguna, you can answer that question as you give your closing remarks.
All right. Thank you, team, for the wonderful presentation. And thank you, our audience, for joining in and being patient throughout the session. We thank you also for the questions that you've asked. As you've been told, that's how you can reach us, as is seen on the screen. And just to answer the question about risk, during the presentation in the beginning, there's something that was mentioned by James about risk appetite. So you have to know what exactly is your risk appetite so that you know which product you can invest in. As well, you have to know what length of time do you want to invest the money that you want to invest in. And also you have to know what is the minimum investment that you're willing to put up. So for Arima, as you've been told, we have the governance committee, which makes the decisions about how the money is invested. So you can be assured that the money is well invested. And when it comes to risk, it's a low risk. And you have the fixed return, which is 15%, which is guaranteed for you. So Arima is a good investment option for a member, as well as the Mana Fund, which I believe was mentioned, which invests in dairy farming. So there are different options that you can invest in. And for any questions that you might have regarding Arima, always feel free to call at any time on the number that was provided for you, or you can reach us on the social media handles. Anything to do with investing, money, we also offer professional financial advice for our members. And that is something that I believe can guide you well when it comes to investing and risk. Thank you. Back to you, Andy.
Oh, thank you so much, Joseph Njuguna. And to our dear audience and viewers, that marks the end of our wealth management training for today. Mine is only to thank you all for finding time to attend to this important webinar on savings and investment. I know we had a lot to speak, but due to constraints of time, we didn't capture a lot, and therefore, I'll invite you to interact with us through the numbers given or via email, or even by simply visiting our offices. And you will be able to understand more as far as what we do offer in terms of advisory on investment opportunities available at Arima Limited and even beyond. So thank you so much. And I only wish all of you a fruitful week till we meet again next time. Thank you so much.